I published earlier today, April 18th, a blog post discussing a sample of what I call small ball common stock purchases, all treasury purchases at last Monday's auction, and most of my corporate bond purchases, roughly equally divided between senior unsecured and first mortgage debt. I remain in an extremely defensive investment posture and consequently have only been slightly negatively impacted by the stock market decline that started after the S&P 500 hit an all-time high of 6,147.43 intraday on February 19th, 2025. The close on April 17th was at 5,282.7. My Fidelity taxable account, for example, is down less than 0.5% from the February 19, 2025 closing value when the S&P hit its all-time high. Yesterday, Thursday, April 17th, that account rose $1,111 in value. The reasons, I should say, for the insignificant decline so far include an extremely low allocation in stocks, as I was anticipating trouble this year. The stocks that I do own going down less than the market averages, with several holding or even going up in value slightly, and a constant flow of interest and dividend income that offsets most of the decline in my dividend-paying stocks. The fact that I have been barely impacted by the stock market's decline does not address the more important and relevant topic, which is, what do I do now? In my opinion, and this has not changed since I last spoke on the issue, investors are still underestimating even after the decline in the stock market, the probability of a serious worldwide recession caused by policy changes in Washington and the upending of the global trade structure that benefited the United States and what the United States created after World War II. Since I do not have to take stock risk, a belief that a worldwide serious recession is more probable than not will result in a cautious approach to buying stocks now, even though their prices are, in many cases, much lower than they were 2 months ago. I am now limiting my purchases to less than my current weekly cash flow from interest and dividend payments. And most of that will be from interest payments. And I may start paring some positions that have gained in value since the market has gone down. In item 3 to my blog post published earlier today, I published snapshots of the cash flow numbers into my Fidelity account from dividend and interest payments on April 15th, 2025. And this is one of the 4 investment accounts that I have. I will generally total up all of the income and all of the dividend and interest income in all 4 accounts in order to make a decision on how much of that will be allocated. And I may just do the allocation in my Schwab account where I have the lowest yield on idle funds, which is 0.05%, which is, of course, ridiculous. I am finding myself gravitating more to buying first mortgage bonds issued by electric utility companies. Those purchases are like a pacifier to me, an old man's pacifier. I discussed in my last blog post purchasing $10,000 in principal amount of $1,000 par value first mortgage bonds, and those were spread over 5 different companies. A new issuer was added to my list, PPL Electric, that is owned by the utility holding company PPL. The Republican tariff taxes will result in higher prices for consumers. If Trump is successful in forcing manufacturers to build new factories in the U.S. to replace lower cost foreign production, which may take 2 or 3 years, the cost of products produced by those plants will be much higher than what could have been the cost sourced from overseas factories, particularly for lower cost items. So while creating a few thousand more factory jobs in the U.S., the Republicans will have caused prices for all consumers to increase based on the differential cost associated with U.S. manufacturing compared to those sourced from places like China and Vietnam and Bangladesh and Malaysia and Cambodia and so on. I discuss an example in my recent post, item 1D, where I discuss buying only 5 shares of Stanley Black & Decker, a well-known U.S. company that manufactures tools. I viewed the significant price decline, which was almost 50% from the 52-week high, and the dividend yield to be attractive, but reduced my purchase amount to just 5 shares due to the inevitable negative impacts to this American company caused by the Republican tariff taxes. The company manufactures, as people are familiar with them, relatively low-cost tools under the Black & Decker, Craftsman, Stanley, and DeWalt brands. The company has factories located worldwide, including the United States, but about $1 billion of the $6.8 billion cost of sales originated from products manufactured in China, which now have a 145% tariff levied against them when imported into the United States. U.S. Tariff taxes will cause U.S. companies to suffer. They will end up having to shed jobs. Their stock prices will decline in response. U.S. consumers will suffer as well. And that suffering, and all of that suffering will continue even when the Republicans achieve their objective in causing more production in the U.S. It is just a completely idiotic economic policy. But what can you expect from the people that we now have running things in Washington? It would be helpful, in my opinion, for those who view Trump as some kind of genius businessman to go back to his origin story that he falsely created as a successful businessman. I have some videos on that topic, which I will link in the more section below.